So good morning everyone. So in the last session we discussed relating to investments. When you are making normal investments, Ind AS 109 will apply. And when you are making investments in associate companies, investment in associate companies, Ind AS 27 for separate financial statement and 28 for consolidated financial statement. When you are making investment in subsidiary companies, then separate financial statements we will prepare as per Ind AS 27, and consolidated financial statement we have to check at the date of acquisition and at the end of the year. So at the date of acquisition we are applying Ind AS 103 business combination. At the end of the year we are applying Ind AS 110 consolidated financial statements. Joint arrangements, Nana. So Ind AS 111 we are having for joint arrangements and joint venture investments. Ind AS 27 for separate financial statements and 28 for consolidated financial statements. So after that, three notes we have seen. So if investments are more than 50%, in that condition, that investor company, we can call it as parent company or acquirer company, and all the investor along with his subsidiaries, associate companies and joint venture, all together we can call it as group companies. That we call it as group companies. And third one is just relating to Ind AS 27. Generally, as per Ind AS 27, when we are preparing separate financial statements, when we are making investments in associate, joint venture and subsidiary companies, so there we are preparing investments in accounting at cost. Okay, if you are applying any possible cases, Ind AS 109 means we will take the fair values. Okay, just for understanding sake, so that is not required much. So next we can put heading meaning of business combination. So meaning of business combination. So generally business combination will occur when an entity having a control over the another entity. Okay, for example, X Limited having the control over the business of Y Limited. Control over the business of Y Limited. X Limited having control over the business. This is very important word. Control over the business of Y Limited. So then we can say it comes under business combination. So when any entity having a control over the another entity. So how do you get the control, Nana? So one condition is that more than 50% of stakes when you hold, you will get a control. Okay. So if any company purchasing more than 50% of stakes in another company, more than 50% of equity interest in another company, then we can say we are retaining the control. The acquirer will get the control over the acquiree. Acquirer will get the control over the acquiree. When we can say, Nana, more than 50% of stakes. That is point number one. Again, control we will get when an acquirer having a control, at the same time the power to appoint the board of directors. If acquirer is having a power to appoint the board of directors, that means the composition and constitution of board of directors. Okay, when they are having a capacity to appoint the board of directors, then we can say again the control will be occurred. So that means here the control will occur. First possibility, more than 50% of stakes. More than 50% of stakes you held, automatically you will get the control. And second thing, control we will get. So if you are not having 50 percentage also, if you are not having more than 50 percentage also, but you have a power to compose or constitute board of directors of another entity. You having a power to compose the board of directors of another entity. Who will be the board of directors? You are appointing that board of directors. You having that power. So in such condition, if you are having a power to compose and constitute the board of directors, again we can say you are having the control. And the third prospect, control we will get when we are having a power to direct. Power to direct relevant activities of another company. So you are having a power to direct the relevant activities means revenue generating activities, operating activities. You are directing the operating activities of any company. In such conditions also, it is under your control. So control will get by the three possible ways. When you are having more than 50% of stakes, we can say that we are getting a control over the business. At the same time, if you are having a power to compose or constitute the board of directors of another entity, then we are having a control over that business. And then we can say, when we can say Nana, power to direct the relevant activities means here all revenue generating activities, you are under the control of. Clearly we can say that all the relevant activities of another company I am activating. That means I am having that power to direct. I am directing how the operating activities will be going on, how the sales will be going on in that company. So like that, all the important activities, so under my control it is going on. In such conditions also we can say I am having a control over the business. So control will be attained in three ways. First one, if you're having more than 50% of stakes, okay, so all the equity shares of another entity, I'm having more than 50% of shares, then I can say I am having a control. I'm having a control means any decision if I want to take, so the majority wins. More than 50% of stakes I am having means, so whatever I'm saying, it will be done by that particular company. That means I am having a control over the business of another entity in decision making. Okay, so decision making means, Nana, for example, I am having 60% voting rights and 40% will be there for another shareholders, other shareholders. I'm having 60% interest in one entity means remaining 40% is there for other shareholders. If any decision have to taken by that company, I am having 60% voting power means automatically my decision will win. That means I am having a control over the business of another entity. If you're having more than 50% of stakes, then you can say you're having a control. At the same time, you are having a power to compose and constitute the board of directors. You are appointing the board of directors. To appoint a board of directors, you are having that power. In such conditions also we can say you are having a control over the business. What is the third requirement? If you are having a power to direct the relevant activities means revenue generating activities. All the important activities of that business I am directing. So my company is directing all the relevant activities of another business, another entity. Then we can say we are having a control over the business. So control can be attained in these three possible ways. Clear? Okay. So now, so generally in the business combination will occur when one entity having a control over the business of another entity. Control over the business of another entity, then we can say it is under business combination. So when we will attain a control means when we are acquiring the control over the business, which is nothing but control can be get in three possible ways. As I told you, what is meant by business? So business means what? Compulsory the other company should have the business. Okay, control over the business. I'm having a control over the business means the other company should have the business. Business means what? Goods and services, so buying, selling. So here under business combination we can say business is nothing but it is an integrated set of three activities. Integrated set of three main activities. One is input, processes, output. Okay, we are having an integrated set of three activities. Business means, again I will give you the notes, Nana, don't write this. So here two words we learn. First one, control over the business. Control means what? Control we will get if you have more than, if you hold more than 50% of shares of another company. So then we can say we are having the control. Okay, here shares means equity shares. You're having more than 50% of equity shares in your hand, then we can say we are having a control over the business of another entity. Again, control we will get, we are not having 50% stakes, but still we are having a power to compose the board of directors of another entity. I'm having a power to appoint a board of directors of another entity as per the agreement or whatever it might be. So then we can say we are having a control over the business, and we are involving in all the relevant activities. We are controlling all the relevant activities of another business. Then also we can say we are having the control. So control can be attained by three ways. These are the three ways. Main three ways is this one, and the fourth one is also there. Generally, it is not like a control if you purchase entire net assets of that business. If you are purchase entire net assets of the business, again you are having a control, but another company will seize, the another company will close. Okay, entire net assets, when you purchase net assets means all the assets and liabilities of another entity, assets minus outside liabilities, then we can say. So when you are having a net assets, entire net assets when we purchased, okay, when we are acquiring entire net assets of that business will close. That business will close, and we are starting the business. We are starting the business with that net assets, or we are continuing the business with that net assets. Here also control we are getting, Nana. Here also we are getting the control. Like that also we can get the control. But major possible ways is more than 50% stakes, and compose the board of directors, direct the relevant activities. Power to direct the relevant activities. Three things are very, very important. Okay, so like that we are getting a control. So control over the business. Business means what? Business is an integrated set. As I told you, we're having three stages: input, processes, output. So what input you are giving to the business? Generally, resources, assets, tangible assets we are giving, intangible assets we are giving, manpower we are giving. So whatever it might be. So whatever the inputs you are giving to the businesses, all the resources we can call it as inputs. All the resources we are used in the business for what purpose? To generate output. So all the resources we are utilized in the business to generate output. So why you are using the machinery in the factory, Nana? To generate goods, to generate the products. So that means in order to generate the output, whatever the input you are taking, all the resources will come out here. Resources like tangible assets, intangible assets, okay, and manpower, okay, all the things, intellectual property rights, everything, that will be the inputs for the organization. So process is nothing but conversion of raw material. Okay, so here I told you input is machines also, assets also we can call it as inputs, not only the inventory. Okay, here processes means how to use the machine, that you should know. Okay, the technical know-how you should know. After purchasing the machinery, how to use the machinery, if you don't know what is the use, Nana? So I am pooling all the resources, all the assets I purchased, how to use also I should know. Yes. So the technical know-how that we are having to use the machineries, again for what? To generate the output. To generate the output, that will comes under processes. The technical know-how used in the assets to generate output. Technical know-how generated to generate the output. Technical know-how how you are using in the assets. Okay, that we can call it as processes. And output is nothing but ultimate revenue after selling the finished product, whatever the revenue you are getting. So the revenue generated, output is nothing but revenue generated by the basis of input and processes. By using this input and processes, we are generating the revenue, that we call it as output. Business means it is an integrated set of three activities. One is input, next one is processes, another one is output. Okay, input includes what, Nana? All the resources, tangible assets, intangible assets, manpower. Okay, so all the kinds will comes under input. Now with this inputs you have to do something, so you have to do some process. Okay, so that means some technical know-how we are utilizing the assets to generate output, that we call it as processes. Output is nothing but the revenue which is generated, by using input and processes. By using input and processes, what is the revenue you generated, that we call it as output. That we call it as output. So if these three activities are there, if these three activities are integratedly, we call it as business. Okay, sir, some of the businesses these three activities might not be there, but still it having the business. Some exceptional cases we are having the businesses until and unless they are not having input processes or output, some of the service oriented organizations are having. Okay, such kinds we can say that is also a kind of business. So generally what is business means, this is the criteria Ind AS 103 is saying. There should be an input, processes, output. Okay, so that means X limited take over the Y limited. X limited is taken over the Y limited. So taken over the Y limited means we can say that more than 50% of stakes. So 70% of stakes holded by X limited. So that means X limited having 70% of equity shares of Y limited. Now we can say X limited is an acquirer, Y limited is acquiree. So now X limited more than 70%. So that means more than 50% of stakes means he got the control. No. So he got the control. Control over what? Control over the business of Y limited. So business of Y limited means Y limited should have the business compulsorily. Y limited should possess with some business. Business means Y limited should have some inputs, processes and outputs. Then only we are purchasing. Then only we are purchasing. So input includes all the assets, process includes how to use the assets, and output is nothing but revenue generating by using the inputs and processes. Okay, so that is nothing but in a simple way we can call it as business combination. Okay, so generally what is business combination means, business combination occurs when an entity having a control over the business of another entity. Control over the business of another entity. That is a major important word. Control over the business. Control over the business of another entity. So here two words, control and business. So control we will get by three possible ways. One is more than 50% stakes, power to compose or constitute the board of directors, and power to direct the relevant activities of the business. In these three ways, any one way we will get the control. At the same time, Nana, what is business means, we are having three activities: input and processes and output. Input means all the resources, we call it as input, and how to use the resources that will be in the processes, and revenue is generating by using the input and processes, that we call it as output. Okay, so like this we can say. So first you write it down, meaning of business combination. Meaning of business combination. It occurs, meaning of business combination. It occurs when a company acquires. It occurs when a company acquires control over the business of another company. It occurs when a company acquires control over the business of another company. So underline this, control over the business. Control over the business of another entity. So first you write down the definition of business. Next heading, business. Business means what? It is an integrated set of three activities. Input, processes, and output. So business means what here? It is an integrated set. It is an integrated set of activities. It is an integrated set of activities having the following three elements. The following three elements. First of all, when business combination will occur, Nana? When a company having or when an entity having a control over the business of another company. So control over the business. So here business means it is an integrated set of activities of three elements. What are the elements here? First one, write down input. Input. So input there itself you can write resources, resources or assets. Resources or assets required to generate output. Resources or assets required to generate output. Example, property, plant and equipment, intangible assets, manpower, etc. Property, plant and equipment, intangible assets, manpower, etc. So on a tangible asset separately we no need to write. Property, plant and equipment means it is tangible in nature as per Ind AS language. So we're having a separate Ind AS as I told you. Property, plant and equipment. Ind AS 16. Ind AS 16. So resources or assets is required to generate output, that we call it as input. What is the second element? Processes. Processes, which is nothing but, so which can simple language you can write technical know-how. Technical know-how is nothing but that knowledge how to use the assets. Technical know-how that can be used in the assets, that can be used on, right, used on assets, that can be used on assets to generate output. Technical know-how that can be used on the assets to generate output. So how to use the machinery to produce the goods? That goods we are selling into the market to realize the revenue. So ultimately, third one, Nana, output. It means revenue by using input and processes. Output is nothing but a revenue by using input and processes. by using input and process. Ultimately, output is revenue. So we are giving, that means which we can say, by inputting some assets, by using that assets, we are producing the goods. By selling the goods, you are generating the revenue. So these activities, all three together, we can call it as business. That we call it as business. So here, as we discussed about control over the business. Control over the business of another entity means compulsorily another entity should have the business. Should have the business, then only we are taken into consideration and taken over of business. Clear, Nana? Next, put heading control. Put heading control. Right, point number A. Control can be acquired by acquiring. Control can be acquired by acquiring majority of stakes. Majority of stakes. Control can be acquired by acquiring majority of stakes. Majority means, Nana, it is more than 50 percentage. So that is, you can write that is more than 50% stakes. When you're having majority of stakes, you're having a control. But or control can be acquired by acquiring power. By acquiring power to compose or constitute board of directors of other entity. Of other entity. The second one, how do you get control, Nana? When you're having power to compose the board of directors of another entity. So another company board of directors, you are having to compose to whom, who have to be there as a board of directors. To appoint board of directors or to remove board of directors, you are having the power. Then we can say you are having a control over the business. Or what is the third one we discussed? Power to direct relevant activities of the business. So control can be acquired by acquiring power to direct all relevant activities. To direct all relevant activities, in bracket you can write relevant activities means so revenue generating activities. revenue generating activities. So you are directing the relevant activities. You are directing the main operational activities of the business. Then also we can say you're having a control over the business. So three things should be there to get a control. First one, majority of stakes. Second one, to compose board of directors. Third one, to direct relevant activities. So you're having all these three. Anyone you're having, we can say you're having a control over the business of another entity. So once you go through this, Nana. So business combination will occur when we are having a control over the business. When you are having a control over the business of another entity, so we will apply business combination. So control over the business means in here we have two aspects, control and business. So business means the integrated set of three activities: input, processes, output. You are having all these three activities, we can say you are having a business. So when I am acquiring that business, which we are having control over that business, control can be attained in three ways. One is by majority of stakes and composing board of directors and power to direct the relevant activities. Okay, so like that, Anna. Okay, so control three aspects we have seen. One note point also write down for this. Control can also be acquired. Control can also be acquired by acquiring net assets, of acquiry company. Acquiring net assets of acquiry company. That means you have taken over assets and liabilities of acquiry company. That assets and liabilities together we can call it as here net assets. Assets minus outside liabilities, as I told you. Okay. So net assets when we are acquiring, so then also you're having a control. Then also you're having ultimate control over that organization. So here what happened, Anna? In this case, acquiry entity shall stop operating. So that we call it as cease to operate. In bracket write down cease to operate. Now acquiry company is not operating anything. So because entire net assets is taken over by whom? Entire net assets is taken over by acquirer company. So when acquirer company acquiring all the net assets of acquiry company, now acquiry company will stop doing the business. That we call it as cease to operate the business. In such condition, so write down also in this case, acquirer company will account business combination in its separate financial statements. only. In its separate financial statements only. Because the other companies stop doing the business. That means they have stopped the business operations. In such condition, consolidation is required, Nana? No, when we are acquiring entire net assets of other business, the other businesses stop operating. In such condition, consolidated financial statement is not required. Business combination we will do in the separate financial statements only. You can write down there, no CFS, no consolidated financial statement in this case shall required or shall be required. So no consolidated financial statements are required for this case. No CFS. So when Nana acquiring what? Acquiring net assets of acquiring company. Then also we can say you having the control. So like that we are retaining the control over the business. Once you go through all the points, Nana. Okay, so here all the aspects, mostly the control, these definitions are not required, but better understanding I'm saying. Because as I told you, we are having holding company and subsidiary company status. So holding company and subsidiary company, when you can say, Nana? When holding company and subsidiary company, now which company have to prepare consolidated financial statement? So holding company will prepare consolidated financial statement. In that consolidated financial statement, holding company elements will be there and subsidiary company elements will be there. Now we are saying that holding and subsidiary company status we will get if holding company have more than 50% of stakes in subsidiary company. Then only we can say this is holding company and that is subsidiary company. Now a company have two holding companies. A company have two holding companies. Any possibility? Now X Limited is having 60% of stakes in Y Limited. I can say this is holding company, this is subsidiary company. Now this subsidiary company have any other holding company? Is there any possibility? No. Now A Limited wants to be the holding company for this Y Limited. So why A Limited also wants to do consolidated financial statements along with Y Limited. See here, if they are having power to compose board of directors, there is a possibility. Because here they are getting the control. X Limited is getting the control by majority of stakes and A Limited is getting the control by power to compose the board of directors. So in such conditions also consolidated financial statements we will prepare. Okay, in generally for understanding. Now as I told you, X Limited having 60% of stakes in Y Limited. X Limited having 60% of stakes in Y Limited. Now we can say X Limited is a holding company, Y Limited is a subsidiary company because 60% of stakes they are having. Okay. Now Y Limited having 70% of stakes in Z Limited. And Z Limited will be the subsidiary company of X Limited, Nana? Yes. Yes. So we're having that stakes here. X Limited is a holding company for subsidiary means, and Z Limited is the subsidiary company of Y Limited. Z Limited is a subsidiary company of Y Limited. In that case, X Limited will also be the holding company for Z Limited. Z Limited. So here A is equal to B is equal to C, A is equal to C. Okay, in a simple way, here X Limited is the ultimate holding company, Nana, and Y Limited is a subsidiary company of X Limited, and Z Limited is a subsidiary company of Y Limited. Subsidiary company of Y Limited. Now my question is, X Limited will be the holding company for Z Limited, isn't it or not? Yes, there is a possibility. There is a possibility. Here Z Limited, we can say it is a subsidiary company for holding also. Now holding company is preparing consolidated financial statement for their subsidiaries. Now X Limited preparing consolidated financial statements. In that CFS, X Limited elements are there, Y Limited elements are there, and Z Limited elements are there. In such condition, Y Limited again they have to prepare CFS, means Y Limited have to prepare consolidated financial statements again, means it is an obligation. Okay, when they are informing all the non-controlling interest holders. This we will discuss in the consolidated financial statements again. There we will get a proper way. Here you want to understand only the thing, holding company acquiring the stakes, either directly or indirectly. So directly or indirectly of any other company, then we can say the control will be comes under the holding company only. Okay, clear, Nana? This is possible only for the 3 stages. Again, some Z Limited is a subsidiary. So here for Z Limited also one subsidiary is there, that is A Limited. Now A Limited is the subsidiary for X Limited, means no. Okay, so first 3 stages only we will check. Okay, so these possibilities we will see consolidated financial statement. This is only for understanding, because we are doing the business combination. When we are doing the business combination, the subsidiary companies concept is important. Okay, so here in such case also, one holding company, that means one subsidiary company having 2 holding companies, there is a possibility. One is having with the majority of stakes, another one is having the power to compose board of directors. Okay, so now next element, accounting treatment. Now wait for a second. This is most important aspect. When we are discussing about amalgamation under accounting standard 14, 2 accounting methods we are having. What are the 2 accounting methods? Pooling of interest method and purchase method. Pooling of interest method and purchase method. I told you in the business combination we have another method, that is acquisition method. So we are preparing the accounting treatment as per acquisition method. So in the acquisition method, what are the steps will be involved? What are the steps to be followed when we are doing acquisition method? Step by step we are going to discuss in this aspect. Okay, so now put heading. Page got changed. Okay, put heading, Nana. Accounting for business combination. Accounting for business combination. In bracket you can put acquisition method. Acquisition method. So Ind AS 103 provides accounting guidelines. Ind AS 103 provides accounting guidelines for business combination. Ind AS 103 provides accounting guidelines for business combination. Nana, we told some cases, case 1, case 2, like 5 cases we have seen. In that business combination where we are applying, in the case 3, when we are making investments in the subsidiaries, when you are making investments in the subsidiaries, when we are preparing consolidated financial statement, when you are preparing consolidated financial statements at the time of acquisition, that means this accounting we have to do. Ind AS 103 business combination accounting we have to do on the date of acquisition. In which date you are acquiring the business, in which date you are acquiring the control of the business. So on that date you have to prepare accounting as per Ind AS 103. So business combination write down on the date of acquisition. This is very, very important. On the date of acquisition. Date of acquisition, we will mention DOA. Okay. So one by one, first step actually identification of acquirer. Identification of acquirer. So you have to identify who is the acquirer. Easier. It is easy to identify acquirer, Nana. Uh-huh. X Limited, X Limited holds 80% of stakes in Z Limited. Who is the acquirer? Acquiry. Acquirer. Easier. Identify the acquirer. Identify the acquirer means here, identify. Here, can I say these are the legal acquirer and legal acquiry, Nana? So X Limited is a legal acquirer, Y Limited is a legal acquiry because X Limited holds more than 50% of stakes. So 80% stakes holded by X Limited, he is acquirer, he is acquiry. But here identification of acquirer means not legal acquirer and legal acquiry. Identification of acquirer means who is the accounting acquirer. Accounting acquirer. 90% of cases legal acquirer will be the accounting acquirer. Okay, 90% of cases legal acquirer will be the accounting acquirer. Sir, what is accounting acquirer? Means in that books of accounts we are doing accounting. In whose books of accounts we have to do accounting means acquirer books. So who is the acquirer? First you should know. In his books of accounts, if you want to prepare accounts, you should know who is the acquirer. The question is who is acquirer? Here legal acquirer is there, legal acquiry is there. Most of the cases, as I told you, most 90% cases, here legal acquirer and accounting acquirer is one and the same. Okay, but some cases we are having, in some cases legal acquiry will be the accounting acquirer. Legal acquiry will be the accounting acquirer. So legal point of view, he is legal acquiry only. But accounting point of view, Z Limited will be the acquirer. That concept we can call it as reverse acquisition. Okay, that we call it as reverse acquisition. Have you heard about reverse merger? Reverse acquisition. So generally listen carefully. Okay. For example, I'm having 100 rupees note. You are having 500 rupees note. So I'm saying I will give you my note, you will give your note. You won't give, right? Because both are notes, a single note only. One note I am giving you and one note you have to give me. Okay? So in that conditions, listen. As I told you, when we are making acquisition, X Limited, Y Limited. Here they are having equity shareholders. Here also they are having equity shareholders. Now X Limited acquired Y Limited business, Nana. X Limited acquired Y Limited business. Okay. Now all the assets and liabilities will be transferred to X Limited. Now X Limited have to pay what, Nana? Purchase consideration. Purchase consideration they have to pay. Purchase consideration they have to pay. Now X Limited is paying purchase consideration in the form of equity shares. In the form of equity shares. Listen carefully. In the form of equity shares. So how they are giving means, so here equity shareholders are there, here also equity shareholders are there. So generally for understanding, number of equity shares, here 1000. number of equity shares 1000. Here also number of equity shares 1000. Okay. For example, you can say 1000 shareholders are there, each one having one share for better understanding. Here 1000 shareholders are there. Here also 1000 shareholders are there. For example, okay, number of equity shares how many? 1000. Here also number of shares 1000. But here the intrinsic value of share is 10 rupees. One share is how much? 10 rupees. Here one share is 50 rupees. Here one share is 50 rupees. That means here one, as I told you, one shareholder, one share value is how much, Nana? 50 rupees. In order to settle 50 rupees, how many shares I have to give? 5 shares I have to give. Okay. So I will give one share, you will give me one share. It won't works here. You are giving 500 note for me, and instead of that I am giving 100 rupees note to you. It is a valid transcription? No. So here it is not a valid transaction. So that means the value is important, not the how many shares you are giving is important. The value is important. That means here the exchange rate, how they have to give. For one equity shareholder of Y Limited, for one equity shareholders of Y Limited, X Limited have to give 5 shares, Nana. Yes. That means 1000 shares. For 1000 shares, X Limited have to give how many shares? 5000 shares. X Limited have to give 5000 shares. Now total company is having how many shares? X Limited having initially 1000 shares and newly issued how much? 5000. 1000 initially and newly issued 5000, total 6000. Okay. This 5000 is given to whom? Equity shareholders of which company? Y Limited. And this first 1000 shares are equity shareholders of X Limited. Out of 6000, 1/6 portion is belongs to X Limited shareholders. 5/6 portion is belongs to Y Limited shareholders. Who is having majority? Who have to do accounting? Y Limited. That is called reverse acquisition. Reverse acquisition. So listen the concept again. Okay. So here X Limited, Y Limited are there. X Limited is generally a legal acquirer. Legal acquirer. And Y Limited is a legal acquiring. Now X Limited acquiring the business of Y Limited. Now Y Limited will transfer all the assets and liabilities. Now X Limited have to give purchase consideration. Yes. So in the X Limited, one share is 10 rupees. In the Y Limited, one share is 50 rupees. Here 1000 shares I have to settle. 1000 shares I have to settle in Y Limited. So for 1000 shares, so 1:1 ratio if I go, okay, here one share is 50 rupees. So 50 rupees share I am taking and 10 rupees share I am giving, he will accept? No. So for him, how many shares I have to issue, Nana? Yes. For one share of Y Limited, in X Limited, how many shares we have to give? 5 shares. Listen carefully. For one share, I told you one share is 50 rupees. One share is 50 rupees. For each share of Y Limited, when I want to give my equity shares, my equity share, each share is how much? 10 rupees. That means I have to give 5 shares to settle 50 rupees for one shareholder having one share each. Okay. So that means I have to give how many shares? 5 shares I have to give to settle one share in the Y Limited. So to settle 1000 shares in the Y Limited, I have to issue how many shares? 5000. These 5000 shares I am issuing to which shareholders? Y Limited shareholders. Y Limited shareholders. X Limited shareholders having 1000 shares. Y Limited shareholders are having 5000 shares. Okay. Who is having the control? Y Limited shareholders are having the control. Okay. So ultimately, Y Limited being a legal acquirer, but for accounting purpose, he is the acquirer. He is having the control and he is the acquirer. He is the acquirer. This concept we call it as reverse acquisition. Nana, again, reverse acquisition, we have a separate concept in the business combination only. We have to do some problems on that also. So there we can discuss it in detail. Okay, this is only the basic level of understanding. So now, first you have to identify the acquirer. Identify the acquirer means identify the legal acquirer or accounting acquirer. Accounting acquirer. Most of the cases, legal acquirer and accounting acquirer is one and the same. But some cases like reverse acquisition, the legal acquiree might be the accounting acquirer. In case of reverse acquisition, reverse acquisition. So that concept. First point, write down. In the accounting treatments, as I told you, step 1. And these steps are very important for acquisition method. One by one, you have to understand it properly. What is reverse acquisition? If you are not understand, also not an issue. Again, we are having a concept there. Okay. So just to understand here, first one, identifying. Step 1, identifying the acquirer. Identifying the acquirer. So first question is what? Who is acquirer? First write down. Acquirer is the company. Acquirer is the company that obtains. Acquirer is the company that obtains what, Nana? Control over the business of acquiry company or acquiry. So acquirer is the company that obtains control over the business of acquiry company. So for best example, A Limited makes 70% investment in B Limited. A Limited made 70% investment in B Limited. Now who is the acquirer? A Limited is an acquirer. Which acquirer, Nana? Legal acquirer. So legal point of view, he is the acquirer. But accounting point of view, we need to check. So on the grounds of law, who is the acquirer? A Limited is the acquirer. For accounting purpose, who is the acquirer? That is what we have to know. Completed, Nana? Same point, just in paragraph wise, you can continue. Identifying the acquirer. Same point, Nana. Identifying the acquirer basically means identifying the which acquirer? Accounting acquirer. Identifying the acquirer, accounting acquirer. Although most of the times legal acquirer, although most of the times legal acquirer shall be the accounting acquirer. Comma at sometimes it may happen that sometimes it may happen that legal acquirer may not be the accounting acquirer. Such situation is known as a reverse acquisition. Reverse acquisition, we will do some long answer questions or long problems. Okay, so we're having a separate concept, separate topic for reverse acquisition. There we will discuss. Just for briefing, reverse acquisition means understood, Nana? So here, after acquiring the business, also sometimes the legal acquiry having the control. In such condition, legal acquiry will be the accounting acquirer. Okay, so here only accounting acquirer point of view we are thinking that. So most of the cases, accounting acquirer and legal acquirer is one and the same. But sometimes the legal acquirer may not be the accounting acquirer. Such concept called reverse acquisition. Okay, up to that enough for this. So what is the first point, Nana? Identifying the acquirer. So identify the acquirer company. Acquirer company, how to identify? So general point of view, when you see legal acquirer, identification is easy. But we want what? Accounting acquirer. Who is the accounting acquirer? Most of the cases, legal acquirer and accounting acquirer are same. But in case of reverse acquisition, it will be opposite. Okay. In reverse acquisition, who will be the accounting acquirer? Legal acquiry will be the accounting acquirer. So that is the first step. You have to identify the acquirer. Okay, so here when you are identifying the acquirer, means all the times X limited acquired Y limited, or A limited acquired B limited. So A limited and X limited will be the acquirers only. Reverse acquisition case, only in reverse acquisition case it will be changed, or otherwise accounting acquirer and legal acquirer is one and the same. The first step is what in the acquisition method, identifying the acquirer. So clear that point. Okay, now second one, step 2. Step 2, determination of the date of acquisition. Determination of the date of acquisition. So second, what you have to identify, you have to determine what is the date of acquisition, because on the date of acquisition only we want all the values, because business combination we are doing on the date of acquisition. So you have to know which is the date of acquisition, in which date the acquisition is happened. So generally date of acquisition means in which date acquirer attains the control over the acquiry, in which date he got the control over the acquiry, then we can, then with that date we can call it as date of acquisition generally. Okay, so if such acquisition, sometimes the government will interfere. Okay, this is not a valid business combination. In such condition, we have to wait for the approval of government. In which date the government is giving approval, that approval date will be considered as date of acquisition. Okay, so generally date of acquisition is nothing but in which date acquirer attains the control over the acquiry, on which date acquirer is attains the control. Acquirer is attains the control means acquirer is getting the control over the business of acquiry. That date we can call it as date of acquisition. So date of acquisition ante ఏంటన్నా, ఏ డేట్ నాడు మనకి కంట్రోల్ వస్తుందో. సో హియర్ in which date the acquirer is getting control over the acquiry business, that date we can call it as date of acquisition. Okay, so all the cases date of acquisition directly they will give you in the question. Or sometimes if any government approval is required, for this acquisition, then the date of approval by the government we will consider as date of acquisition. Okay, so that is the thing. So X limited, for example, X limited, Y limited. So here X Limited acquired the business of Y Limited as on 1/4/23. 1/4/2023. Here, in this date, they are acquiring the business. So, that will be the date of acquisition. Okay. Now, government is interfering that this is not a valid business combination. Now, it is under the trial. The government is involved. Now, when the government is giving approval, in such conditions, very rare circumstances, so if it is under the government approval, the approval date, in which date the government is giving approval for this business combination, on that approval date will be considered as date of acquisition. Second one is date of acquisition. First one, Nana, identification of acquirer. Identification of acquirer means which acquirer? Identification of accounting acquirer. Second one is determination of date of acquisition. In which date the acquisition is happened, that we call it as date of acquisition. Second step, write it down. Date on which acquirer acquires then have you understand my writing here? Acquirer acquires control over the business. Control over the business of acquiring company. Acquirer acquires control over the business of acquiring company. On which date they are acquiring the control, that date will be considered as date of acquisition. We'll stop next paragraph. But if any approval is required, if any approval is required from the government, then date of approval shall be considered as date of acquisition. Now, multiple choice questions, important this aspect. So the approval date, determination of date of acquisition. First one, identification of acquirer. Second one is determination of date of acquisition. So determination of date of acquisition. These are the first two steps we have to follow. When we are following the acquisition method, first you identify the acquirer. Identification of acquirer means identification of accounting acquirer. In which acquirer books we have to prepare the accounts. First you have to identify him. In case of reverse acquisition, acquiree will be the accounting acquirer. Simply we can say legal acquiree will be the accounting acquirer. So reverse acquisition cases we will study in the middle of this chapter. Okay, so at present it is not required. This is only the basic level how to do accounting for business combination under acquisition method. We have pooling of interest method and purchase method, just to leave it for side for some time. So here we are following acquisition method only. You have to follow acquisition method only under business combination Ind AS 103. Under accounting for business combination as per Ind AS 103, we have steps for acquisition method. First step, you have to identify the acquirer. Identify the acquirer means identify the accounting acquirer. Accounting acquirer. Most of the cases, legal acquirer will be the accounting acquirer, and very rare cases like reverse acquisition, legal acquiree will be the accounting acquirer. Okay, so that we need to understand, because first if you identify the acquirer, now acquirer accounting we will do under his books. Acquirer accounting we will do under his books. We have the accounting in the books of acquirer, we have the accounting in the books of acquiree. Sir, if legal acquiree will be the accounting acquirer, then who will be the accounting acquiree? Who will be the accounting equerry? Equerry books also you have to do accounting now. In such condition, then legal acquirer will be the accounting equerry. So in the reverse case, when we are doing accounting, on that stage we will see that. So up to then, just to leave about reverse acquisition, general acquisition only you can see. So acquirer books of accounts, how to do the accounting, and equerry books of accounts, how to do the accounting. What rules you have to follow? Step 1, identification of acquirer. Step 2, identification of date of acquisition. Okay. So third one. So 3 steps we can see in this class. Determination of purchase consideration. Determination of purchase consideration. So how do you determine the purchase consideration? So generally in the question they will give you the purchase consideration. If not, how to apply net payment method? Have you remembered net payment method? So how much cash you are giving, how many assets you are giving, how many equity shares you are giving, how many preference shares you are giving, how many debentures you are giving, all the things if you add, we will get purchase consideration, Nana. Yes, but at which value we have to give? Okay, what is the value? So major thing is fair value. So generally purchase consideration, it will be there in the problem itself, or otherwise how to find the purchase consideration. Determination of purchase consideration is the third step. Okay, so write down. Generally, amount of purchase consideration shall be available however it can be computed as follows. It can be computed as follows. Okay, so first, purchase consideration means, as I told you, you can pay anything. You can pay cash, you can give equity shares, you can give preference shares, you can give debentures, you can give assets. And what are the other things we need to consider while calculating the purchase consideration? So here, put particulars. Amount. So how can you determine the purchase consideration? This is the third step. First step, Nana, identification of acquirer. Second step, determination of date of acquisition. Third one, determination of purchase consideration. How PC can be computed? First of all, what you are giving. So generally when you are paying cash, so cash paid, first element cash paid. Next, if any assets you are giving, Nana, if any assets you are giving, so the fair value of that assets we have to take. Fair value means on that date of acquisition, what is the fair value of the asset? Fair value, which is nothing but the market value of the asset we will give. So on the spot, if you sell that asset, how much it will be realized, that we call it as fair market value, as I told. Okay, so here write down fair value of assets transferred. Okay, if you give purchase consideration in the form of assets, you are giving assets. Nana, you are taking assets, that is different. Now you are giving assets as a purchase consideration that we are discussing. So whatever the assets you are giving, the fair value we have taken into consideration, not the book values. In your balance sheet, you are giving one machinery for a purchase consideration. As a purchase consideration, you are giving one machinery. In your books of accounts, the machinery value is 1 lakh, but we have to take the fair value of that machinery. Fair value might be 70,000 or 60,000, means we will consider it as 60,000 only. Okay, fair value of assets transferred. Next, fair value of equity shares issued. Fair value of equity shares issued. Okay, that means you are issuing equity shares as a part of purchase consideration. As a part of purchase consideration, you are issuing equity shares. Generally, equity shares of 10 rupees each you given. But that 10 rupees share in the market, it is 120 rupees. The fair value of the share we have to consider. As I told you, the share value, it might be 10 rupees. But in the market, the value is how much? 120 rupees, means we have to consider 120. What is the fair value of equity shares that you are giving to them or issuing to them as a part of purchase consideration? For example, I have to give 10 lakhs purchase consideration, Nana. In this 10 lakh, I can give 1 lakh cash or 2 lakhs equivalent equity shares. This 2 lakhs of equity shares, whatever giving, that should be at fair values. So the fair value we have to count, and accordingly, how many shares you have to issue, you will get it. Okay, so the fair value of equity shares issued we have to take into consideration. Next one, fair value of debentures issued. Fair value of debentures issued. So you are giving purchase consideration in the form of debentures. That means instead of paying cash, you are giving debentures of your company. Now that debentures also fair value we have to consider. What is the fair value of the debentures that you are issuing? Okay, so simply we can say that the other company on the spot, if they sell the debentures, on the spot if they sell the shares, how much they will realize, that we call it as the fair value. Okay, up to here clear, Nana? So now, if any deferred consideration is there, deferred consideration means now we are not paying. Okay, we are saying that this much amount I will pay now, and after 5 years I will pay remaining 10 lakhs or remaining 2 lakhs. So if any deferred consideration is there, deferred consideration means we are not paying at present, after for some time, on future time we are paying that amount, that we call it as deferred consideration. If any deferred consideration is there, we have to calculate that deferred consideration to the present value and we have to record it. Okay, so if any deferred consideration is there, so simply I'm saying that out of 10 lakhs, 8 lakhs I will pay now, and remaining 2 lakhs after 2 years I will pay. Remaining 2 lakhs after 2 years I will pay. That means the 2 lakhs value is after 2 years. After 2 years he is paying only 2 lakhs. What is the present value of the 2 lakhs? We have to calculate. What is the present value? It might be less than 2 lakhs or more than 2 lakhs. Less than 2 lakhs. So 2 lakhs you are getting in the future, means what is the value at present? The present value of deferred consideration. If any deferred consideration is there, that present value of deferred consideration also will be added into the purchase consideration. Write down present value. This is not fair value. Present value of deferred consideration. Present value of deferred consideration. Deferred consideration means, Nana, that consideration we are not paying at present, we are paying in the future. So after 2 years or after 3 years we are paying. Okay, so deferred is nothing but postponement. So in the future date we are paying that. So that future date consideration, what is the present value we have to calculate? You know that PV factor, how do you calculate? So same way we are calculating the present value factor here, and we will record the present value here. Okay, so next, Nana, have you understand about contingent consideration? So contingent consideration. What is contingent consideration? Contingent means may or may not. Okay. Contingent consideration means, So here contingent consideration means the net actually it comes under here. We are saying that after 2 years, we will give you this number of equity shares, fixed number of equity shares. So previously I told after few years I will pay fixed amount. Okay, it is not the fixed amount. We are saying that so this amount we will pay. At present the share value is 10 rupees, Nana. Fair market value is 120, for example. Okay, at present the traded price is how much? 120. Now I am saying to them, so here at present I will give you this much amount, and remaining I will give in the form of equity shares, but after 3 years. After 3 years I will settle the remaining consideration in the form of equity shares. After 3 years the share price will fluctuate. At present means 120 per share. Okay, I am saying after 3 years I will give you 15,000 equity shares of my company. 15,000 equity shares of my company I am paying you after 3 years or after 5 years. Now can you say what is the value of that 15,000 shares? We don't know. After 2 years, what is the market value of the share? You can calculate at present. No. Okay, if you know the amount, we can make into the present value. Okay, if you don't know the amount, how can you make it? Such contingent considerations, if anything are there, that also we have to take it into consideration. Okay, so write down fair value of contingent consideration. Okay, so that is amount. Future delivery, in the future I will deliver this number of shares, I told them. So what is the value in the future? We don't know. Okay, such conditions we can call it as contingent considerations. Such contingent considerations also we will consider the total value we have taken as a purchase consideration. The total value will be considered as purchase consideration. Like this we will determine the purchase consideration. Don't worry, most of the times purchase consideration they will give you in the question itself. Okay, so if they have not given this, all the elements we have taken into consideration, that is the point. Okay, consideration calculation is different, net assets calculation is different. So how to do the net assets, how to take over the assets and liabilities, so in the next steps we are going to discuss. Okay, 3 steps we have completed: identification of acquirer, determination of date of acquisition, determination of purchase consideration. Okay, so what is business? Integrated set of 3 activities: input, processes, output. And control can be attained how many ways? 3 ways. More than 50% of stakes, compose board of directors, power to direct relevant activities. Okay, so clearly business combination will occur when an entity acquires the control over the business of another entity. That point is very important. Control over the business of another entity. Okay, so remaining steps in the next session we can see now.